welcome to today's show. Top trading thoughts for Tuesday, February 22nd, 2022. Welcome to my guests, as always, Mark Phillips from Harvested Financial and Jason De Lorenzo from Adeum Funds.
Getting better, Lex.
I got that. Oh my God.
Getting better.
What's the date today? 2.22.22. Is that correct?
Yeah, it's also my toddler daughter's 22nd month.
22nd month. You're still counting months up to age 2, I think, right?
I guess.
And then you go by a year.
But it's cool that it's her 22nd month, and she's on 2/22/22.
That is correct. So we got a lot of twos.
I guess.
I love it. I love it. Okay, guys. So the markets have been crazy, right? Very volatile. Mostly volatile down. I guess we had a few volatile up days, but boy, they seem heavy. Obviously, we know there's this Ukraine-Russia thing weighing on the markets. There's inflation. There's all kinds of things. We're not necessarily here to talk about that. We're here to talk about more of the, the science behind some of this stuff, or some thoughts about markets and trading. So, Jason, I'm going to start with you, Mr. Under Over VIX, because I know there's a lot of data going around relative to where the hedge flows are sitting right now. So explain some of that to us, if you will.
So, sure. Right now, option liquidity is not really there. There hasn't been a lot of hedging for this event. It's been mostly selling. And as I've said numerous times, selling is bearish, hedging is bullish. And what you want to see is people buying puts to try to hedge a downside move. This way, the reason why you want people to buy puts is market makers then will sell initially in order to hedge their positive delta position. But as time goes on, those puts will deteriorate, and that is called charm. It's the time effect on delta. And also, as implied volatility comes down, they are also exposed to vega, to implied volatility. And then the derivative of that is vanna, which is the reaction of the options to changes in implied volatility, reaction of the delta of the options with relation to the change in implied volatility. Mm-hmm. So those are the two things you have to think about when people are buying puts. At this point in time, however, people are not buying puts. They are just selling their stocks. And we're seeing big red numbers without associated option hedging. And what we need is people to start buying puts in order to create that vanna support under the market. That is not there right now. The level that I see right now of vanna support starting to kick in is at 42.60 SPX, which is not too coincidentally around where the futures, ES futures, bounced last night at 42.50. Mm-hmm. I wouldn't be surprised to see a revisit there, but in a very volatile time without a lot of vanna support, expect the market to be heavily exposed to headline risk. Mm-hmm. Any kind of inflation, Fed stuff is going to have a big effect. Even war stuff in the short term will have a big effect because there's a lot of raw materials, energy, nickel, which is used a lot in EV and batteries. There's some raw materials that are coming out of Ukraine and Russia that flows will now be disrupted. So people will sell on that kind of headline. So just be careful, because I do still see short-term downside, even though in the long term, I am bullish on the markets.
Okay, good.
So how do you think about trading something like this? Obviously you could put out a buy order at 42.50, but what are you thinking about with an option structure here? How do you think about, playing that reversion?
Personally, at this point in time, I would be long gamma pretty much all times. You don't want to be one of those put sellers because you have a limited gain. Even though VIX is high and implied volatility is high, it is not high enough to account for the current volatility in the market. So you want to be long gamma. You want to have verticals. When you look at the risk profile of your trade, you want the verticals to be pointing away from the current price of the market, either bullish or bearish, however you want to position yourself. Mm-hmm. Those are the kind of trades that I would do. Personally, if you are bullish, strongly hedge. And if you are bearish, keep your size small. And also very fixed risk. So something like verticals or something like that. Do not sell naked calls. I wouldn't do anything like that.
Wait, how else are you going to make money if you don't sell naked calls and puts? What do you mean, Mark? That's what we always did.
Yeah, it's like buy a call that is closer to the money and then sell one that's further away by a certain distance.
Yeah.
Things like that. I don't, as a RIA, I'm not allowed to give investment advice, so I'm not going to give.
I thought you could give investment advice as an RIA.
Yes, I could give it if I want to get that whole RIA thing revoked, but
Yeah, exactly. So, it's counterintuitive a little bit, Mark. In our day, high volatility, which it probably is, you tend to sell that, right? At least we did because we were on the other side of everything. But I think Jason's saying it's high, but relatively speaking, it's not high enough. It should be a lot higher than what's indicated. So therefore, it's a relative buy. I'm making that up, right? As opposed to an absolute, which is interesting because most people don't think that way, right?
And I think the overall VIX levels aren't even necessarily showing that we're in a particularly high volatility environment right now. And one of the other things that I would point out to trade this kind of environment is that you probably want to be pretty aggressive about taking your profits quickly. If you are in that sort of long gamma situation and we do drop down, you've got a kind of a bearish put spread on, or a bearish call spread, and we rock it up, you want to be pretty greedy about taking those profits. And I think when the markets are chopping around like this, you want to shorten your trade horizon typically, and because they're just as likely to revert back the other way. That's kind of what high vol means, or higher vol means.
Right. Yeah, and then the other thing I want to do, Jason, is before the show you showed us some graphics of charm, vanna, what else was it? Over VIX, under VIX. Let's revisit that in a future episode, because here's what I think. I think that's very helpful when people can see graphs and diagrams. I think they get it a lot better, and it's really important to understand what you're talking about relative to these levels, because understanding the dealer market and what's going on there really has some great foresight, I think, into market movement, or at least potential market movement. Volatility, choppiness, all that kind of stuff can be sort of garnered from some of this stuff, right? So I see that in a future episode if we can.
Yeah, it needs editing. This was that dashboard that I've been kind of cryptically talking about on Twitter a little bit, saying that I'm going to be releasing this thing that's going to graphically show you exactly where bounds are and why they're there. But yeah, I'd be happy to show graphics once it's edited properly.
Okay, terrific. Mark, so you were going to talk a little bit about liquidity, the bid-ask spread a little bit, the what's it called, the lit spread versus the effective spread. Let's explain a little of that before we have to run. What do you think?
Yeah, definitely. So I think once we have a trade idea out there, like, generally we're talking about being long gamma, whether you're bullish or bearish. I think when markets are really moving around like this, it's also important to think about how you're actually going to put that spread on. And, one of the common things we tend to see is when things get a little choppier, people increase their price. I think a great way to think about the difference between the bid and ask spread is the confidence interval of those liquidity providers. And as things start to move around, they want to increase their confidence interval on that theoretical value. So markets are going to widen out. They need to be better compensated for the risk that they're taking. So when those markets widen out, it can be a little bit more expensive to put on a trade. So when I talk about the lit versus the effective spread, there's more that goes into the actual cost to put on a trade than necessarily what you might see on the screens. So if you're looking at a bid-ask spread that's 20 cents wide, you might say, okay, fair value marking at your broker is, at the midpoint is a dime. That's going to cost you 10 cents to pay the offer or sell the bid. You also have to take into account kind of two other major factors. One would be the overall fee of your trade. And especially for some of the more active traders, those fees can really add up. Often at a discount broker, that trade might be zero, but there might be a per contract fee. So thinking about that, thinking about the maker taker aspect of your trade, that's going to play into it. makers are typically credited, and takers of liquidity are typically debited. They pay. So while you might not necessarily be paying that, the person that's routing your order is going to be paying that. And so they're going to have to think about where to route that in exchange for, all the sort of super fees that goes into it. So if you want to be aggressive about taking liquidity, perhaps you might not be getting as much price improvement as if you were to post in the middle of a spread, for example. So that overall price improvement is going to come down to a lot of different factors. And I think in addition to thinking about how you're posting your liquidity, the time of the day that you're executing is also really important. So don't wait until the very end of the day to close your spreads. If you have a butterfly spread that's closing on expiration Friday, 3:59 p.m., you're not going to get the best price. We typically tend to see a saddle curve of volume during the day, but we also see people de-risking at the end of the day. So, you're not necessarily going to squeeze those last dimes and pennies of value out. So another thing to sort of consider in this overall soup of executing, because all those pennies that you save are going to add up to your overall sort of performance. And they really do matter, especially for the more active traders out there.
Yeah, that's interesting. So in these kind of environments, how do you recommend a retail trader, managing his book, right? Or his or her book? It can be a little dicey, even something as liquid as the spiders, right? I mean, I know in our trading day, spiders were always very liquid, right? But there were times in these volatile markets that they went like this, whoop, and then all of a sudden, what do you do? And I think you said a couple things. Don't wait till 2:59 Central Time to get out of these things. You probably have to have a little patience and some steel in you to play in these markets.
Yeah, that's definitely true. And I think looking at your overall spread, if you're going in and it's a 10-cent wide market in the spiders, maybe you try to be a little bit more patient and see if that's going to settle down, like if we just made a big move. I think counterintuitively, one of the things that actually works well is hitting the bid or taking the offer. And, people might say, oh, well, I want to try to get a little bit of price improvement. I want to, put out a floating order. What's interesting is that for the people taking the other side of those orders, they're possibly more likely to give you price improvement if your order price is at the bid or the offer, because it marks well on their statistics. If you post a mid-market order, they don't get credit for giving you price improvement. But if you pay the offer and they improve you by a penny or two, they actually get to pad their stats. So as counterintuitive as that seems, sometimes hitting a bid or taking the offer will actually result in better price improvement.
Yeah, that's interesting. That's an interesting point. I didn't think about that. That's exactly. So you don't get price improvement at midpoint as a dealer.
I used to see this all the time, actually, when executing. If I would post a mid-market order, it wouldn't get filled, but then I would pay up to the offer and I would get price improvement, perhaps sometimes even better than what I was posting at originally. Right. Because generally the people eating the flow see their stats divided into two categories of marketable flow and non-marketable flow. And marketable flow is something that's paying the bidder offer. And that's where they really want to demonstrate improvement. And so they're going to, especially on small orders, they're going to drive those pennies in your favor by, if compared to the bidder offer that it was posted at the time.
Okay. Understood. Yeah.
Question.
Yep. Go ahead, Jason.
Mark, you were saying that 3:59, Eastern time, I guess. 3:50. Eastern time, 3:59 is a bad time to take off your trade. When is a good time to put on or take off a trade?
I think in the morning, I wouldn't go for that, right at the opening bell. Things sort of need to settle, but that generally is a pretty active liquidity time. And so, trading early in the morning, I tend to find, you see pretty decent liquidity. But I think especially that 3:59 on expiration, or going into a Friday or something, people don't want to give the price improvement then, no matter what the statistics look like, because they don't want to get hit with a trade and all of a sudden have, deltas that are exposed there. So, if you want to trade towards the end of the day, sort of get closer to that, quote unquote closing price, starting to look in that 3:30, 3:45 is when the closing imbalances numbers come out. So that's another kind of figure that people start to look at to sort of position around. So I wouldn't push much past that though, because people start to, widen out and get ready to go home for the day.
Yeah. What about you made mention of maker taker fees. Can you just go over that one more time so the folks understand that that's not necessarily something a retail person would receive, right? That's a market maker pro term.
Correct. Okay. But at the end of the day, your order is getting executed by those pros. Right. We all know that the market makers are kind of sitting in between the exchanges and the retail customer flow. So how your order looks is going to dictate how it gets executed. So, if you're taking that liquidity, that might be an additional fee to them, but then they get that whole potential price improvement offset there. Mm-hmm. If you're going to be posting something mid-market, that might not actually be or that could increase the appeal sometimes if they're going to get that maker credit. But again, then they have the offsetting price improvement question. So, you can't necessarily guess exactly what their economics look like, what their statistics are going to be. And, but it's, I think, important to consider what's happening further down the line in these orders.
Sure. Okay. That's good. This is good stuff, man. I'll tell you. You guys are really smart. You guys get the brain wave right here. Look at this. That's what you get. I love it. So really good stuff. Great show. You guys have a great day.